This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Getting closer to the end of the week. It's a Thursday morning. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Nigel and Rima is here with us over the next 2.5 hours. Guys, hi, good morning.
Hi, morning.
Hi, good morning. After yesterday's drubbing, looks like today is going to be a bit soft to begin with.
Drubbing and super drubbing.
Super drubbing. Let's hope India, provides that comfort with its match against Bangladesh
Yeah,
today.
let's hope we're going to come out on top. I have no doubt about my boys. No surprises when we play.
I like it, my boys.
my boys are coming out on top for sure.
Mere ladke.
I couldn't make it to the 15th, so
All right, well, let's just kick it off with what you need to know as we sort of begin this morning. So it's a classic risk-off overnight. The reason I say it's a classic risk-off because, yields went up, the dollar was up, oil was up, equities were lower. And it's a mix of things, right? I mean, it's geopolitics, which has been festering at the margin. It's not as if there's something big which has happened overnight. There was some Fed speak, there was this and that, but overall it was down and out. So let's just begin with the bond market because that is where bulk of the ugly price action actually shone through. The 2-year broke above the September highs at 5.18%. We ended actually at about 5.22. And now we are basically, if you just look chartically, eyeing the 2006 highs at 5.27. There is no sign of exhaustion or anything. The 10-year went up, the yield went up 7 basis points, and we left off at about 4.91. So these are large moves, and even the 30-year, for example, is now back above 5%. So this is the structure that we are looking at and have to deal with. The dollar got pulled up as well, about 0.25%, 0.3% higher. 106.56 is where the dollar index left off at. You've got the equity market, which sold off. The S&P was down about 1.3. The NASDAQ was down 1.6. And the Russell 2000, the small cap index, was down over 2% as well. So again, these are substantial cuts. There were some earnings as well, and I just want to pick up one, which is Tesla, because, as I called it 2 years ago, talismanic Tesla, right? I mean, that is basically the torchbearer for a lot of retail sentiment in the U.S. It missed Q3 earnings expectations across basically most operational matrices, and the numbers came through post-close, and the stock, I think the last I checked in after hours, was down about 5% or so. Oil prices, it's going in the opposite direction, opposite in the wrong direction, 1.6% higher, over 91. Iran is now calling for an oil embargo on Israel. And as I said, that geopolitics and the fallout, etc., is uncertain. So conviction remains extremely low one way or the other. There was some Fed speak as well. So two governors who spoke, well, they said that perhaps we need a higher neutral rate. But there were others, actually one who said not really entirely agree with that. But in any case, I think, we will hear from the Fed chair himself. That is later today. Which way he leans, I think, will be important in that sense, in that context. And that may be actually a big one because we started with the bond market, yields rising, etc. If he very definitively says that he doesn't see the risk for a higher neutral rate and what we've done is okay, and market interest rates rising so much means that we don't have to do very much, we may actually see a big reaction when we come back tomorrow morning on yields. Let's just tie this into what levels look like. So the Nifty yesterday closed just a tad below the 20-day moving average. So that stands at 19,673. We left off 2 points under it, 19,671. That will go as we start this morning. So the support then for the Nifty comes in at the 40-day exponential moving average, which comes in at 19,648. Yesterday at the low point, we kind of were not quite there, but 20, 30 points off it. So we'll see. The lower support beyond the 40-day exponential comes in around the 19,498 kind of levels, 19,500, round number there. So we'll see how things open up. The Nifty Bank was the weaker of the two indices. Once again, it lost a full 1% plus. It broke the 43,900 levels around which the markets found support. And I would say the August low is back in play. We toyed with that 43,600 levels for so many weeks when we were back there. I think that comes back into clear view once again. with the kind of cues that we're being handed from global markets, etc. The gift nifty will come up on your screen. I mean, I think this is largely, I would say, a no-trade day. You could look to buy the dips, but then you'd have to be very nimble and quick enough to get out and not really wait to find out by 3:30 what the close is going to look like. So that could work, but I would say, I mean, better to just stay out and let this kind of resolve itself, because we've been in this 19,650, 19,850 range for a long time, and we are now again testing the lower end of that bound. Rima.
Hi, just a quick word on Asia this morning. Firmly lower. You've got cuts of more than 1.5% on the Japanese index, more than close to 1.7% gone on the Hang Seng. The Korean markets are reeling with cuts of close to about 1.5%. So Asia is firmly lower. Earnings are picking up steam. So today the Indian markets will react to the 4 nifty companies, all 4 of them, Bajaj Auto, Wipro, LTI Mindtree and IndusInd Bank, reported numbers post-market hours. So today that reaction will play out. Today is going to be a big FMCG day. 3 heavyweights, HUL, ITC, Nestle, all 3 of them report numbers. And another nifty company is Ultratech Cement reporting numbers. And on the mid-cap end of trade, Havells, Emphasis, PVR, Inox, Tata Communication, UBL, Voltas. These are some of the F&O mid-cap companies where you typically see a lot of action surrounding earnings. Today is also the Nifty weekly expiry. It's a Thursday, so you've got the Nifty weekly expiry. And finally, as Prashant said, the big Q will be post-market hours at 9:30 p.m. India time, when Fed Chair Jerome Powell will speak and perhaps provide some direction, some way to gauge the way the U.S. yields have been rising.
Rima, since we're gripped with the Cricket World Cup, today's scenario for the Bulls is they need to chase 350 to 400 runs. It's been done before, but the odds are against them doing it. Because that's the way the cues are stacked up. So global cues are against the Bulls. You have the Nifty Bank as well that's under pressure. The bears will be feeling very, very good. The big question is, does the Nifty Bank want to correct a little bit more, go to the 200 DMA, which is closer on 2% away from current levels? So that's going to be the vital factor. And if you look at the heavyweights, well, you'll want one of those heavyweights to put their hand up and get counted, whether it's the HDFC Bank stock or Reliance Industries or both of them together. You want them to, hold one end up, because otherwise it's going to be difficult to hide for the Bulls. The Nifty Bank is under pressure. The IT earnings as well have been a little bit weakish. So it's difficult to hide. So that's why you want HDFC Bank and Reliance Industries to outperform. HDFC Bank actually has been getting sold into any kind of bounces as well. And just take a look at yesterday. The Nifty Bank ended at the low point of the day, but that's because it played out weekly expiry as well. So that could be a factor at play. There was shorting on the Nifty Bank. Well, yesterday you had the Nifty Bank that ended lower with a cut of 500 points. And the open interest was up closer around 28%. So shorting being seen out there. And that perfectly fits in with what the FIs did in the F&O markets, because they added 15,000 shorts for 7,000 longs in the ratio of 2 shorts for every 1 long position. The net short positions on the index itself are closer around 71%. Bulk of the shorting yesterday was done on the Nifty Bank. Now the PCR, that's a crucial technical indicator. When it goes around 0.67, 0.7, we see the Nifty see a bit of a bounce. Now it's got some distance to go from there, though it's come down to around 0.8 odd. Why is that? Because call writing has been very, very aggressive. Now take a look at the highest open interest on the call side. That's nearly around 1.6 crore shares. While on the put side, it's less than a crore shares. So the difference between the highest call and the highest put open interest is nearly around 70 lakh odd. That's what's giving you the kind of confidence on the bearish perspective. They are feeling very, very good. They're writing calls very aggressively. Which brings us to the level. Since the 19,600 put has the highest open interest and the premiums around 21 rupees, you'll want the Nifty to defend, the lower end on a closing basis. That's around 19,000, close to 19,580 approximately. On the upside, the 20 and the 50 DMA, that's going to be important. The 200 DMA is very, very weak. So very far away from current levels. So on a closing basis, you want the Nifty to defend 19,580. And the Nifty is facing resistance at high levels, the 19,850 level. Just take a look at last 6 sessions. 4 times we have gone close to those levels, and we have seen selling from there as well. The Nifty Bank, well, that's been weak, and that's right in the middle of the 20 as well as the 200 DMA. Let's pull up actually the Nifty. The last few days, it's been going to 19,850 and seeing selling. Those intraday highs should come up for you, and from there, we have been seeing some selling. The Nifty Bank, pat in the middle of 2 crucial levels. Let's see which way it's going to swing. But the odds are against the Bulls today. Let's see if we see an intraday recovery and that lasts, because there are likely to be those intraday pops. So it's going to be a trader's market. But as I said earlier, the bulls will be feeding on the back foot.
I like that cricket analogy, Nigel. So
It's been done before.
It's been done before, but it's tough. Well, before we go any further, let's quickly tell you what's lined up in the first half hour of the show today. We'll get you updates from markets across the globe. Dean Kim of William O'Neill will be getting us the global perspective in just a bit from now. Our research team will get you the CNBC-TV18's list of 10 stocks for the day. And at 8:30, we do a fundamental stock check. Deepan Mehta of Elixir Equities joins us for that.
On to equities then. Jonathan Garner of Morgan Stanley says MSCI EM, that's emerging market equities, have fallen 10% since the 28th of July, retracing half of their gains from October of 2022. He sees the market at a crucial juncture given the still negative earnings revision exacerbated by the USD strength and a challenge to the valuation from rising geopolitical risks and the 10-year US real yields retesting their post-2007 highs. He says they reduce beta but increase their overweight stance on Indian equities as their most preferred emerging market.
Okay, well, let's get you some money market views. Parul Mittal Sinha of Standard Chartered Bank says the USD INR continues to trade range bound. She says the impact of the dollar strength, higher oil prices and risk aversion was contained by probable RBI intervention to help smoothen volatility. She expects the USD INR to trade between 83.1 to 83.4 to the dollar next week with focus on forwards maturity of $5 billion. That's next week.
On the bonds, Parul says India rates are moving in a very narrow range amid geopolitical tensions in the West Asia and fear of a potential OMO sale announcement. She says flows from offshore investors due to index inclusion have been muted so far. Rates as an asset class is not in favor at the moment. She expects the 10-year benchmark bond yield to trade in a range of 7.25 to 7.4% in the near term.
Well, we've got plenty of stocks that we're going to be focusing on, so let's get straight to our special Top 10 segment, which we'll be addressing in greater detail in just a bit. We're looking at Bajaj Auto, LTI Mindtree, IndusInd Bank, Coforge, Persistent Systems, ICICI Lombard and Astral. Nearly 7 stocks are likely to react to positive news flow, while on the flip side, you have Wipro, Bandhan Bank and Dabur that could be opening up in the red.
Okay, well, Dean Kim is now joining us, head of global research product at William O'Neill. Dean, good to have you with us here. Technically, the S&P and the NASDAQ, are they going to see a bigger dive from here?
Yeah, we're kind of in a precarious situation at the moment. And today, we saw the U.S. market being under pressure as the 10-year bond yield is now elevated to 4.9%. So now we believe that there's a real possibility that the yield can get up to 5.25. And so both S&P and NASDAQ are now below key moving averages, but still above the 200-day moving averages for now. We do need to see both indices sort of bounce. But, given the hawkish view of the Fed and also the bond market being elevated, it may be difficult in the short term.
Dean, morning. We're getting conflicting messages about where the monetary policy might be headed. On one hand, you've got U.S. inflation, which is moderating. But on the other hand, you've got relentless rise in the U.S. 10-year yield. And you're saying it's possible we could head back to levels of 5.25, something that we had seen, I think, way back in 2006. Where is monetary policy headed? And in case in the November meet, we do get a bit of a dovish signal from the Fed, how would the markets react?
Yeah, I think the problem with the bond market situation is, there's just not enough demand for bonds at the moment. So last week when the Fed had the auction, the uptake wasn't that strong. As a result, the yields went up. So actually, this may be a good tool for the Fed because the bond market is doing the job for them. The financial conditions is getting very tight in the U.S. As an example, mortgage is now heading up towards 8%. Pre the rate hiking cycle, we were at around 2%. So for the consumers, they're going to start to feel the pinch. And in that way, with financial conditions being so tight, the Fed can actually stay the course and keep the rate higher for longer and not necessarily raise rates. But the market is expecting one more rate hike. So that's on the table still.
All right. Hi, Dean. Good morning. Could you tell us what about the Indian markets? Normally you do a bit of techno funda, so to call it, and you give us some support levels on the Nifty. If you've got a level for the Nifty bank, because, that's been the big underperformer for us. Even in this month, the Nifty is more or less flattish. The Nifty bank is down nearly around 1.5% to 2%. So your view on the Indian markets and those levels you're tracking?
Yeah, so in terms of the sensex, I think the next price support is at the 100-day moving average, which is 1% below. Currently, it is testing the 50-day moving average. So if we can bounce from here, that would be great news. But should we breach that level, the 100-day moving average, which should act as strong support, is about 1% away. Now, in terms of the private sector banks, HDFC, chart-wise looks the weakest. And actually, even the public sector banks, they're kind of testing the short-term moving averages. And we do need to see a bounce here. Otherwise, they may be testing the 50-day moving average. So I think the next few trading days will be quite critical.
Dean, you have a view on oil technically again? I mean, it was before this thing broke, the conflict broke, oil actually was on the mend. It was coming off. Since then, it's added about $5 or so. What's your sense?
Yeah, I think oil, we look at it as a barometer of what's going on in the Middle East. I think if there's going to be escalation in terms of the war, unfortunately, we're probably going to see the oil price spike. And so if we get up to 90, beyond 90, we're going straight to 95. But in terms of currently where oil's sitting, it's at around 87. We see next support at around 85, which is the 50-day moving average. But I would, stay close to the conflict that's going on in the Middle East. Escalation is going to drive oil prices, unfortunately.
Despite India being a preferred country in the emerging market basket, the FPIs continue to sell in the Indian markets. With financial conditions remaining tight in the US markets, do you expect FPI selling to persist?
Probably we're going to see, money flows out of emerging markets. Indian market is by far the best market in emerging markets and perhaps on a global basis. But we may see some selling pressure. When I look at Asia, the AAXJ, for instance, there's a lot of resistance towards the 200-day moving average. And right now it looks like they're going to be testing the bottom of the base that we're currently in. And so the FDIs, basically, they're moving money out of emerging markets, and perhaps they're going to move more into the bond market as yields become more attractive. So that's the dynamic that we're dealing with.
Okay, all right. That seems to be the case because the bonds are looking a little bit more attractive at current juncture globally, actually. But final question, Dean, before we let you go, there'll be some outflows from emerging markets. But within emerging markets, India still stands out, or in the near term, given the valuations, given the data points that are coming in, yesterday the GDP number coming in from China as well looked a little bit better. Will you think that, in the near term, China could outperform for a couple of quarters?
I think China's GDP was good news, but, it's interesting that the market didn't react that way. The market actually sold off. And so that's kind of concerning. But I always, come back to India in terms of its fundamentals. You have many companies that's generating double-digit earnings growth. A lot of, organic growth being driven within the country. I think India is a safe haven amongst the emerging markets. There's a lot of stuff. Of course, there's a lot of extended stocks, but there's a lot of opportunities as well.
Okay, on that optimistic note, Dean, we'll thank you. Thanks so much for joining in. India could be the preferred market, but in the near term, maybe a flight to safety, which is bonds in comparison to equities globally. is Dean's call, and we're very close to a support level on the sensex, 1% away from that 100 DMA. For the time being, though, we'll slip into a short break. When you come back, we'll focus on the top stocks that you need to track. Don't go anywhere.
Welcome back. There's going to be plenty of action today. Lots of earnings reaction. Our entire team is standing by with CNBC TV18's list of top stocks for the day and kickstarting it with Bajaj Auto. Sonal, how did the numbers look?
Well, the numbers look better operationally. Margins were higher. They came in at 19.7% versus a poll of 19.3%. So operationally, it was a good performance. Margin growth, this was driven by better realization and a richer product mix by the company as well. And quarterly EBITDA, it has surpassed the 2,000 crore mark for the first time. And revenue growth came in single digits. This is despite 8% YOY fall in volumes. It is because of the price hikes that the company has undertaken. So a good set this time. Taking you through the numbers quickly, revenues, as I said, single-digit growth, 5.5% higher. EBITDA was up 20% at 2,100 crore rupees. Margins were higher on a YOY basis, higher than the poll as well, coming in at 19.8%, leading to a profit growth of 20%. Talking about the balance sheet as well, their first half of FY24 saw free cash flows of 3,600 crore rupees, which is up 1.6 times versus first half of last year. And brokerages, they are positive on the stock. Jefferies has a buy rating. They have increased the target price to 6,000 rupees a share. And Morgan Stanley also has an overweight rating. They have a target price of 5,449, giving a thumbs up to the numbers as well.
All right, Sonal, thanks very much for that. In fact, Rakesh Sharma, who's the executive director of Bajaj Auto, will be joining us for a chat at 9:30 this morning to discuss those numbers in greater detail. But we got tech numbers which are sort of, flowing through the door. Wipro reported numbers, LTI, Mindtree as well. Rima, how do they look?
They flooded me more instead of like,
have a good weekend, Rima, because you worked so hard.
I've earned it. Okay, so let's quickly get started with Wipro. It's a weak set of numbers. ADR was down more than 3% yesterday. Q2 numbers, top line came in lower than what the street was anticipating, declining by 2%. This is the third consecutive quarter of a revenue decline for Wipro. The problem is the Q3 outlook is even worse. The guidance is a dampener. The company is guiding for -3 to -1.5% growth in Q3. The positives in the numbers were steady deal wins, strong, in fact, there is a moderation in attrition. Margins have been stable. The company is guiding for stable margins, but there is no growth at Wipro. So that stock could remain under pressure. LTI Mindtree has reported a steady set of numbers, largely in line with street expectations. Revenue growth of 1.7%. Margins have come in better than what the street was anticipating. They've declined on a quarter-on-quarter basis because of wage hikes, but slightly ahead of what the street was anticipating. Maybe the street will latch on to the management commentary. So yesterday, in the conference call, they guided for a strong H2. They said H2 will be better than H1, and they also said that we're confident that exit margins, that's Q4 FY24 margins, will be 17 to 18%, and they retained that over the next, 2 to 3 years, they will see margins improving by 200 basis points. So LTI Mindtree, steady, good set of numbers, no surprises, but the management commentary was positive, saying that H2 will be better than H1. So good numbers there.
Okay, all right. Well, let's talk across to Ekta. She's filling in to tell us about IndusInd Bank. Ekta, those numbers look quite good.
Well, yes, I expect the stock to be in the green, or rather Abhishek Kothari expects the stock to be in the green. 11 quarters of a year-on-year and Q-on-Q growth in operating profits. In Q2 of FY24, operating profit growth was 10.26% year-on-year, 1.33% Q-on-Q. The gross NPA ratio, 11-quarter low. Net NPA ratio came in at an 11-quarter low as well. The net interest margins at an 8-year high or more, so it came in at around 4.29%. And the NII as well as the profit beat estimates. So that's the reason why I'm going with green this morning on IndusInd Bank.
Okay, thank you for that. Two more IT companies, Persistent and Coforge. The Coforge has reported a steady set of numbers. Revenue growth has come in at 2.3%. They've maintained their top-line guidance for the year at 13 to 16%. Order intake has been strong, above $300 million. Persistent, too, is a healthy set of numbers. Top-line growth at 3.2%, slightly ahead of street expectations. Margins, though, have missed the mark. Margins have declined by 120 basis points due to wage hikes. Deal wins are at a record level. But all in all, both Coforge and Persistent have reported steady set of numbers. But Ekta, back to you. Bandhan Bank, it looked like a weak set of numbers.
Well, yes, it looked like a tough quarter for Bandhan Bank. The asset quality worsened, stress pool has risen, the numbers were below the pole. So gross NPA ratio 7.32 versus 6.76% Q-on-Q. Net NPA ratio has risen to 2.32 versus 2.18% on a Q-on-Q basis. The emerging entrepreneur book, which is a vertical which they started around 2 to 3 years ago, the book has risen around 11.3% on a Q-on-Q basis, and it now forms around 6.4% of their total loans, which is positive. But the asset quality overall would probably weigh, along with the fact that the NII as well as the profit has been below our estimates.
All right. Ekta, thanks very much for that. That's Bandhan in focus. ICICI Lombard is the next one, which we're going to focus on. Surabhi's got details here. Surabhi, morning.
Good morning. So ICICI Lombard, it was a good set of numbers. The gross direct premium income, that was up 17% on a year-on-year basis. The combined ratio came in at 104 versus 105, and that was lower because the lower loss ratios, especially in the motor book. The expense management ratio was at 28.6%, slightly higher than 28% last year, and that is because of the competition intensity. The claim ratio at 70.7% versus nearly 73% same time last year. The management has said while the core combined ratio has improved, the competitive intensity remains high, discouraging them from revising their combined ratio guidance for FY25.
Right. Okay. Surabhi, thank you very much. By the way, we'll speak with the management of ICICI Lombard at 9:50 this morning. So that's, again, another big conversation you don't want to miss. But Surabhi, back to you. Astral is the other one. Super performer, unlike ICICI Lombard. In terms of the stock price and the numbers came through, how do they look?
The numbers were pretty much in line with our estimates. The revenues were up 16.3%, came in at 1363 crores. The poll was of 1362 crores. They've seen a gross margin improvement of nearly 800 basis points, and that was because they had higher inventory losses same time last year. Margins have come in at 16.1% versus 12.3% same time last year, and the net profits are up 90%. Operationally also very strong. The volumes were up 28%, and EBITDA per kg, that is up 26% on a year-on-year basis.
All right. In fact, we'll be speaking to the management of Astral on the quarter numbers at around 9:40 a.m. later today. Well, let's go to Mangalam. Mangalam, Dabur, negative news coming in.
Well, there is, sentiment negative news coming in for Dabur. Overnight, the company has informed the exchanges that there have been litigations against 3 of their subsidiaries in the US and Canada. And consumers have alleged that some of their hair relaxer products have caused, some forms of cancer as well. And for this, there have been approximately 5,400 cases that name Dabur's subsidiaries along with other companies as well. The company on its part says that the allegations are based on unsubstantiated and incomplete study. And the defense costs for litigation are expected to, they will inform the exchanges of these costs if at all they are material in nature itself. However, there are 2 things that stand out. One, that the products that they're talking about don't account for more than half of their 0.5% of their overall sales. Secondly, this is not new news. This is just an information to the exchanges, because if you look at the company's conference call transcript in the first quarter itself, they've said that a litigation has been filed against 3 of their subsidiaries, and along with them, they've also named the litigation has also the names of companies like L'Oreal, Godrej, Softsheen, Avalon, Revlon. So it's an industry-wide related issue, not a new issue, not very material in terms of their sales, but definitely a sentiment negative.
Okay, all right, Mangalam, thanks for that. Well, here's a quick recap of all the stocks we just covered. Let's run you through the list with regard to positive news flow. Bajaj Auto, LTI Mindtree, IndusInd Bank, Forge, Persistent Systems, ICICI Lombard, and Astral. While stocks with negative news flow include Wipro, Bandhan Bank, and Dabur.
Okay, let's move on and talk about commodities. Manisha Gupta joins in for a complete roundup of all the action. Manisha.
Well, thank you so much for that. We're looking at the crude oil prices holding close to 2-week highs, off its highs, those, as the U.S. has now issued a 6-month license authorizing transactions in Venezuela energy sector. That would mean more supplies coming in for the global markets. And even as Iran has called for Muslim countries' embargo against Israel, Israel imports 250,000 barrels per day from countries like Kazakhstan, Iraq, and Azerbaijan. And they're all close allies to Israel. So a disruption in crude supplies to Israel also is off the table. The only thing that is supporting the crude prices is the U.S. crude inventories, which has seen a sharp decline on a week-on-week basis by 4.5 million barrels. Even the gasoline inventories have seen a decline by 2.4, and that has been supportive for crude prices. Markets do believe that after 7.5% of gain in the previous week for crude, we are holding nearly 4% on the higher side, and that's perhaps how we'll close the week on the higher side as well. Of course, it is going to be about the U.S. Powell testimony today in the evening. Further direction would come in from that.
Thank you very much for that. We'll get into a break. On the other side, we'll invite Dipan Mehta of Elixir Equities, and we'll chat about some of these stocks which are on our radar today.
Welcome back. Hope you're having a good morning because the equity markets are likely to be under some pressure. Global cues in a bit of a tizzy. Yields spiked up. We had crude oil prices that went up and the dollar index was stronger as well. And putting all those cues together, the GIFT Nifty suggesting we pull back more than 100 points. But individual stocks, well, plenty of reactions is what you're going to see. And help us out with some fundamental analysis. Deepan Mehta, Director at Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Always good to see you in Deepan. Let's discuss a couple of stocks then. IndusInd Bank came out with its set of numbers. They look quite good. And they're guiding for better things as well in the second half of the year. Your view on the stock?
Good morning, Nigel. Thank you for having me on your show. I think great set of numbers from IndusInd Bank. Last 2-3 quarters have been exceptionally good, especially under the new management. And valuation-wise also there's a lot of comfort. So I think that from investors' perspective, this is a good stock to buy. And first, the disclosure, we and our clients are invested in IndusInd Bank. And these are really blue sky scenarios for banks per se. Credit growth is good and NPA cycle has not turned bad, so the credit costs are lower. And banks just need to invest in technology and make sure that the credit growth is in line with industry or slightly better. And of course, the operating leverage benefits are also coming through for most of the banks, including IndusInd. So very positive IndusInd Bank. I think there's a case for re-rating of the valuation ratios.
Okay, got that. Deepan, hi, good morning. Your thoughts on Astral, which reported numbers, and Polycab, which reported numbers. Polycab seemed like a beat on all accounts. Astral was more in line. But from a stock perspective, what's your sense?
Yeah, I think very good set of numbers from both companies, especially Astral. Quite impressed with the paints and adhesives growth as well, because that's going to be the real engine for Astral going forward. They already have a dominant position in the plumbing side, but these are the new emerging businesses. How they are shaping up is very important. The only issue with Astral is amongst the most expensive building material stock, even more expensive than maybe Asian Paints. Having said that, I think Polycab also very good set of numbers. And really the cable division is firing on all cylinders for Polycab. The only disappointment is that the appliances business, which Polycab is focusing on, the value-added businesses, those are not growing as fast as the cable business. But nonetheless, I think the company is on a solid footing. Valuations, I think, are still more reasonable. So I would say that both are, if you have them in your portfolio, remain invested. But from a fresh investment perspective, I think, the valuation do not justify and there may not be adequate margin of safety.
Okay, so the risk reward is not favorable for a fresh entry into either Astral or Polycab, given the current high valuations. Wipro is a stock on our radar. They reported their Q2 numbers. Numbers came post-market hours. It's a weak Q2. The top line declined by 2% quarter on quarter, and the company has guided for things to deteriorate further in Q3, guiding for a -3 to -1.5% growth in the October to December period. Listen in to what the management had to say about the company's performance, what led to this weakness.
The revenue has been, at a little lower than expected. And, while in the guidance still, the reality has been that, the market has continued to be a little, difficult over the last few weeks. We have seen, same volume of reduction of discretionary than, a little more than what I would have anticipated.
We did indicate that our margins will remain range-bound in line with what we have delivered over the past few quarters. There is a salary increase which will be rolled out effective 1st December. So we will have 1 month impact of those salary wage hikes. And in Q4, we will have 2 incremental months compared to Q3. How much and the quantum, it'll all depend, but it is likely to remain in the same range as what we've done.
We have not onboarded freshers in H1. We had made offers last year and we need to onboard them as the market improves. So far, we have not onboarded freshers in this year.
In the communications sector, we are seeing still a certain hesitation to engage on discretionary spend. Maybe discretionary spend would be in the 20-25% of our portfolio right? You know, not all consulting is discretionary spend. Some technology is discretionary spend. It's not that simple to just characterize this category. You know, our guidance for Q3 include the fact that, you know, we are seeing furloughs, as you know, in Q3. Typically, this is when they're coming, and there will not be smaller in volume this year than they were last year.
That's Wipro. Another important thing that they said in the conversation was, we asked them that what is your dependence on the discretionary spending? You know, what we call the discretionary spending. Most IT companies are unable to quantify that. But the company said that approximately 20 to 25% of their portfolio today is dependent on discretionary. So it's part of your consulting business, etc. So only when the discretionary demand turns around, spending starts on discretionary projects, then perhaps Wipro could see a bit of an uptake. So that was an interesting takeaway. Dipan, amongst the IT companies, and most of them have reported, at least all the 5 large cap IT companies have reported. We've got a few mid cap IT companies. Which one stands out to you, and which one would you recommend a buy on at current levels?
Well, disclosure, we and our clients may be looking at buying that company, but I saw that Newgen Technologies, their interview yesterday, and it's a company we've been tracking for a long time. Unfortunately, we have missed the bus over there. But clearly, I think the company has gone from strength to strength, and its business model is largely focused on domestic market, partly coming domestic market and other markets. And it's slightly different from some of the other typical software companies per se. And the way they were speaking about the large order wins and the large contracts they have got, I have a great faith that this company will do really well going forward. The only issue was high debtors, but that also was coming off. Having said that, I saw persistent numbers, I saw Coforge numbers. I mean, they're good, they're better than industry standards, but nothing, which will, make us stand up and say, look, this is really going to be an outlier and it will perform exceedingly well going forward. I think the pain in the IT sector is being felt across the board, and this may last for a quarter or two. And unless you have a contrarian type of investment strategy, it does not make sense to invest in any of the typical IT companies, be it large cap or mid cap. It's better to just wait and watch at this point of time. And the geopolitical issues, I think, certainly will be on demand and will push the demand revival maybe for a few more months or quarters. So things are not looking that great for IT stocks, according to us.
Okay, not looking great for IT stocks. Dipan, you told us about IndusInd Bank, you like those numbers, but Bandhan Bank, asset quality seems to be an issue out there. Those numbers didn't look very, very good. Your view?
See, I think, Bandhan Bank clearly has disappointed the market big time, and it came with a lot of promise. It was the first bank which went from a microfinance NBFC to a bank, and they tried to scale up other businesses. But somehow, even in the microfinance side, they have been, hit with large NPAs, which are unusually high. Maybe it's geographical concentration, maybe it's the lending practices, I cannot say. But even when you compare Bandhan Bank to some of the other microfinance banks, stroke NBFCs, the performance is certainly not that impressive. Valuation may be cheap, but that's because of high NPAs in the past, and it also had a loss quarter. So when you have so much of choice in the banks, it's best to avoid Bandhan Bank. We spoke about IndusInd Bank. I thought Federal Bank also came with a great set of numbers. Bajaj Finance also now getting into that nice valuation comfort zone as well. And if they can maintain these kind of growth rates, I think it'll start to outperform over the next 2-3 quarters or so. So I think there are many choices. Best to avoid Bandhan Bank.
Dipan, have you looked at out of the blue question, but a company called Tega Industries? It's an interesting company. I remember speaking with them here on the program. They're in the steel mill ancillary kind of support. They provide lining for steel sort of furnaces. Have you looked at it, Tega?
Similar to what AI engineering does, if I'm not mistaken. And I think these are great times for such companies. A capex cycle reviving in India, and the way the rupee is going, there's a huge export market also opening up for such companies. Steel prices also have been pretty much curtailed. And these are great value-added products and niche products. And it's just a matter of convincing the customers to go for such options and such solutions given by these companies. So very positive on such businesses. I don't have a handle on the valuation, but if it is reasonable in that 25 times kind of a zone, or rather I would say PEG of less than 2, then certainly the stock is worth looking at.
Okay, just one more point, Prashant, on this company. It's more involved in the OPEX, not in the CAPEX.
Yeah.
So if new CAPEX is not added, it's still okay because you have to change the mill line.
There's a lot of replacement demand, basically.
Exactly. So that's one factor.
I remember speaking with them, and I noticed that yesterday it was up 10%. I don't know if the results came or what, but it was up sharply yesterday. Well, Anuj is here with how he's looking at the market. I mean, overnight, Anuj, classic risk-off day. And I think we're going to start lower to begin with.
Absolutely, Prashant. Morning. And you know what? I'm going to start with the chart of the day. And that clearly is the one which is putting a lot of fear in the market. This is the US 10-year bond yield. I mean, just look at that. There was a bit of a breather that we got about here. But over the last few days, it's really off the charts. And, if we hit 5%, it will be the first time that we'll hit 5% since 2007. So almost a 16-year breakout is what you're looking at on the bond yields. And of course, that is why today's session is make or break. The Nifty ended at the lowest point for first time in the October series. And I'm tracking two levels, October 9 and October 10 lows, which are 19,480 and 19,565. Basically, if the thesis is that the market made a bottom with bad news, then those levels have to hold. The Bank Nifty has once again proven to be the problem point for the market. And it looks like, we could be testing September and October lows for Bank Nifty. And then the next level to watch would be straight away with a 200-day moving average at 43,186. For today's cues, of course, today's weekly options expiry. And the big one is the Fed chairman's speech, which happens at around 8:30 in the evening, our time. And there are some big consumption numbers lined up, ITC, Nestle, Lever, Havels, and UBL. Quickly coming to levels then, on the Nifty, the first support is 19,561, the 10th October low, and big support is 19,480, the October 9 low, which is Monday after the war day. On the Bank Nifty, the two levels to watch out for, 43,443, the June series base, and 43,186, the 200-day moving average. HDFC Bank once again showing weakness. Now, you could have periodic short covering, but it's an index which positionally has become very weak.
Okay, all right. Thanks a lot for that, Anuj. Well, let's focus on a couple of numbers that we're expecting then later today. Ultratech Cement. Well, that's one stock that we'll be looking at. The big boy, the big daddy from the cement space will be delivering numbers. And normally it comes during lunchtime. Now, if you look at it, in terms of a stock price movement, it's not moved at all in comparison to the last quarter. So in quarter one, the stock price till today, it's absolutely on the day that they delivered numbers, is virtually not moved. Just 1% or thereabouts of movement that we have seen. Consolidated numbers, what do we expect? Well, you have revenues that should come in higher by close to around 14.5%. EBITDA number will jump up by close to around 38%. And profitability as well will be high by close to around 71%. Remember, we have a cheat sheet for Ultratech Cement because now they've started delivering their operational numbers. And the volume growth was very, very impressive. So on the consolidated basis, it was up close to 16%. Part of that includes the Middle East operations. But the India business, the growth has been impressive at close to around 15%. So they have outgrown the industry, indicating they've gained market share. And a seasonally weak quarter, capacity utilization levels have been the highest that we've seen for quarter two in the last many years. And that's on a higher base. So that's pretty good as well. Blended realizations, though, they'll be flattish to marginally down on a year-on-year basis as well as on a sequential basis. So bulk of the top-line growth or all the top-line growth will be because of volumes. What are the factors that affect margins, though? The realizations, well, they don't play a role. In fact, they'll be a bit of a drag. And they have a couple of sticky costs because they've increased, their increments are likely to reflect in quarter two. And also, there's been a couple of maintenance costs as well that could dent that performance out there. Operating leverage could play out in their favor, though. And input costs, that's power and fuel costs, could dip a little bit. PAT number, well, it sees a bigger jump because of higher other income and lower effective cost. We'll be waiting for management commentary. And the debt number as well has come down to reasonable levels of around 2,500 crores. But they have been, increasing their capex. So we'll have to see where that number goes. Deepan is still with us. Deepan, the big daddy comes out with its set of numbers. What do you expect from it? And what's your pick from the cement pack? I don't think you're very positive on the cement names, but your view.
No, I think Ultratech will come with a great set of numbers. It's a sweet quarter for the entire cement sector. Volumes have been exceedingly strong, prices have been stable, and a lot of the benefit of the lower raw material costs, lower power and fuel costs, transportation costs will flow to the bottom line. So I think it's going to be a great quarter from that point of view. Maybe next quarter also will be phenomenal anyway. Next 2 quarters are very busy for the cement and industry and seasonally very strong. So you could see cement outperform in the short to medium term, but longer term prospects are not looking that great. the way capacity buildup is happening, I'm so sure at some point of time there could be a glut and there could be greater, price wars as well, which may keep margins depressed. But I think next 2 quarters look very impressive and very strong for the cement industry. And Ultratech being the largest player, I think they should report very good set of numbers.
See you on Dipan. We need to get into a very short break. We'll come back and also get into a few F&O and trading strategies. Stay tuned.
Okay, welcome back. There's 9 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with how they're looking at things and, of course, some trading ideas as well. Gentlemen, good morning. Good to have both of you here. Mitesh, we'll start 100 points lower. That's what the GIFT Nifty was indicating. What after that?
Yeah. So, good morning, Prashant. Yesterday I said that, while we've been looking at a range kind of scenario for many days, with the fall which happened yesterday, the hourly charts had started turning negative, and there was a real chance of us breaking below 19,650, which I think will happen with the gap down today. While there's good support around 19,500 and then at about 19,350 levels, in the worst case scenario, I think I'm even penciling in that we could go and test the lows which the market had tested in the month of August, which is 19,230, 250 zone. So I think be prepared for some tough days, some days which will be negatively biased. The key here could be the Bank Nifty. See, the Bank Nifty, has been underperforming and has a good support around 43,400 and then at 43,200, which is the 200 average area, which Anuj also highlighted. The risk is that the weekly chart of the Bank Nifty on a closing basis shows a possibility of a double top formation, which means that we will not only go to 200 average, but there's a strong chance of us breaking below that. And technically, if that happens, if we start trading below 43,200, then there's a good chance of another 1,000 to about 1,500 point kind of a correction happening on the Bank Nifty. So I'll be very negative for the next few days to come by. And maybe after the gap down, if there's some rebound of 40, 50 points, I will go to buy into put options for the November expiry of both the indices.
Got it. So you're foreseeing some pain ahead for our markets on the Nifty and on the Nifty Bank. Sudarshan, are you also negative just in the near term?
Yeah, good morning. See, the market is likely to open below 19,600, which was a minor support level. Once support is broken, the markets can do whatever they want on the downside. So there are no levels to assure viewers that this is where it will stop. We don't know. So the primary task is protect your capital, stay away from the markets, do not trade. You cannot go. Usually, it's difficult to go short after a big gap down, and this is not a time to buy the dip because the trend is now short-term trend is clearly down. So stay away from any kind of activity.
Okay, stay away from activity, but individual stocks, Sudarshan, you've been maintaining the stance as well. On the Nifty, there's no big trade, but individual stocks is what you've been focusing on. So give us a couple of ideas.
Sure. See, there's one stock that is a buying opportunity, and that's ITC. It was in a trading range, and now it's breaking out of that range on the upside. Now, this is a positional trade. It's not an intraday trade because intraday markets are not conducive for any kind of buying, but it's worth looking at. So buy ITC with a stop under 435. Biocon is an intraday short. Yesterday, it had a very big down day, breaking down all kinds of support levels. Short with a stop above 252. Manappuram is on the verge of a breakdown. It's not done that, but the signs are that it will probably move on the downside and break the support levels that's holding it.
Okay, we'll wait for him to complete that call on Manappuram. But in the meantime, Mitesh, you want to fill us in with your stock calls?
Yeah. So, while I have a negative view and today I have 2 buys and 2 sell calls, I'll be more aggressive on the selling side. So I have a sell on Adani Enterprises with a stop just above levels of 2450 and a target of around 2300. Bharat Forge also appears to have given some negative breakdown on the hourly and the 2 hourly charts. So sell here with a stop at 1125 for a target closer to about 1070, 1065. And then a buy on Chambal, which I would want to buy on a decline. So around 290, buy with a stop below 285 for a target of 302. And similarly, Cipla also, if I get a gap down and if I can get a long trade in the range of about 1200 to about 1195, then Cipla can be bought with a stop at 1178 for targets of 1240.
Okay, thank you very much. Here's what we'll do. We'll slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Polycab India's Chairman, Managing Director, Inder T. Jaisinghani, and the ED and CFO of the company, Mr. Gandharv Tongia, to discuss their Q2 earnings and the way forward. Stay tuned.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. And as we speak, we're getting into pre-open, and there are plenty of results that we're going to be tracking. But a quick check on the GIFT Nifty, that's suggesting we pull back a good 100 points to kickstart trade. Global cues are in a bit of a tizzy. Global markets on the whole, Asian markets as well, are under some pressure. But we've got a lot of earnings reactions that we'll have to deal with. So let's get straight to the first management that we have on the show. Polycab, that's the first corporate on our radar today. The numbers look quite good. The problem is yesterday the stock did come off the high point of the day, but that's predominantly because of valuations. To understand more about the past quarter and the way ahead, we're joined by Mr. Jaisinghani, the Chairman and Managing Director of the company, and Mr. Tongia, the Executive Director and CFO of the company. Good morning, gentlemen. Thanks so much for joining in. Well, let's clear out a couple of details. Very, very impressive revenue growth is what you've given in the cables and wires business, but we're missing out on the volume number. Now, we have it at the unofficial number. I think it's around 30% odd. But could you clarify what was the volume growth for the past quarter? What was the price growth as well in the domestic market? And have you gained any market share? Have you outgrown the market?
Good morning, and thank you for having us. Your unofficial number is right. It's 30% in domestic business. There is a very limited pricing effect. There's probably 2-3% here and there. So entire growth, what we are seeing in domestic business is coming from volume growth. As far as market share is concerned, it appears that we would have gained market share, but we'll probably will have to wait for the other companies to declare their results, and probably after that we can take a view on that.
Mr. Tungia, compared to the first quarter, good morning to you and Mr. Jaisinghani, Prashant here. Compared to Q1, this is a bit of a drop-off, isn't it, on the volume front? I remember Q1 numbers were the range of 45-50%. What is a sustainable number from here on? Because there were some industry capacity constraints as well, which may have helped at the margin over the last 2 quarters. But what's sustainable from here on the volume front?
So as part of Project Leap, and about which we spoke in the last interaction as well, we aspire to get to 20,000 crore rupees of top line. And this ambition was set in 2021. As of now, we have done 8,000 crore rupees of top line the first half, and it appears that we should be able to get to 20,000 crore rupees top line before fiscal 26, so the guidance is fiscal 26. As far as volume is concerned, we firmly believe that our volume growth is going to be better than the industry growth. I won't be able to give you a very precise growth target on volume, but I can tell you that it's going to be significantly better than the industry growth, both in the domestic arena as well as the international business.
And what should domestic volume growth be, industry, in the ballpark?
So it depends on the various factors, but if we were to take historical data, it is a multiple of, the total growth is a multiple of GDP, anywhere between 1.5x to 2x, which includes volume as well as value. Generally speaking, value is the major constituent of that growth. Volume is the balance part.
Mr. Jaisinghani, morning. This is Reema here. Just a quick follow-up. When do the industry capacity constraints ease off? That's question number one. And also, if you could tell us what the export performance has been this time around.
Demand is basically going up continuously because of infrastructure work. So capacity, what is there today, it is going to be concerned within 2 years.
Okay. And sir, what about exports? What was the performance in Q2? What can you guide for the second half of the year? And you had earlier spoken about how exports can contribute about mid-teens to your overall portfolio. Where does it stand at right now?
So let me take that. Exports is around 400 crore rupees in the second quarter. Between Q2 and Q1, we would have registered a growth of almost 14%. As part of Project Leap, we aspire to get to 10% of exports contribution to the top line. And currently, we are hovering around that, around 9-10%. Exports continues to be a focus area for us and a good growth driver. There are large economies like US, as well as Middle East and Australia, where we are seeing a fair amount of momentum. And we believe on a mid-to-arm to long-term basis, exports is going to be a positive both for the industry as well as for our company.
Okay, all right. Gentlemen, I wanted 2 numbers from you all. One is on the margins. The last time around, you all were guiding for 12 to 14%. Well, in the cables and wires business is a little better than that. Now you're going to be spending more on advertising as well. So give and take everything. The higher ad spends, the movement in raw material cost, what could the margin number look like? You could give it to us for cables and wires and also the blended margins. And also I wanted to ask you about, your working capital days. That's moved up because of a shift in payable days. What is the likely number? So 2 numbers, margins and working capital days.
Sure, thank you. So as far as cable and wire is concerned, we'll continue to maintain margins between 12 to 13-14%. That's the traditional margin range as well. You're right, we have upped our investment on advertisement publicity. In fact, in this current quarter, we have relaunched our logo and carried out a brand refresh. We'll continue to make that investment. Generally, it is around 2.5% to 3% of our B2C business. In the coming years, it's possible that we up it and take it to 3 to 5%. As far as FMEG is concerned, that is slightly softer for us as of now, but we believe that we should be able to get to 10% of EBITDA margin in FMEG by fiscal 26. On working capital, your observation is right. We are around 50 days of working capital, which includes both receivables, inventory, and payables. Generally speaking, our receivables are anywhere between 25 to 30 days, and difference between inventory and payables is around 20-25 days. And we believe that anywhere between 50 to 60 days of working capital is sustainable for us.
But I think you're being conservative on the margins. You're again talking about 12 to 14% and you've done more than 14%. On a blended margin basis, would you like to revise the guidance upwards? Now, for the last quarter as well, you've done around 14.5%. I mean, I think bite the bullet. Don't you think you want to go ahead and revise that guidance upwards?
That's a great one from you. So as far as margin is concerned, I think it's best that we maintain equilibrium between the top line growth as well as EBITDA margin. And we believe that a range of 12 to 40% is sustainable. And that is why we are continuing with our guidance.
Okay. Mr. Jaisinghani, you said that current industry capacity will suffice for the demand for the next 2 years. That's what you said, sir?
Yeah.
So will you, and hopefully things will continue on the infrastructure side in a solid way. So you will have to put up more capacity. Is capacity coming on at other players as well? What is the scenario?
Yeah, we have to increase the capacity because nowadays the infrastructure work is going on very, very fast. And today demand of all utilities have increased, building construction is increased, everywhere demand is increasing. So everybody is trying to increase the capacity. We are also on that phase, which is we are thinking to increase little capacity 25-30% more because we know that demand is going to be coming continuously.
Mr. Tongia, talking about capex, you already have a 700 crore capex plan where you are setting up that extra high voltage facility in Halol in Gujarat. This comes on stream in FY26 in this 20,000 guidance that you have given. Does it include any revenues from, EHV, or is it going to come only after? And what will the margins be once it comes on stream?
So as far as 20,000 crore guidance is concerned, that excludes the new facility, which will be operational in fiscal 26. The margins are going to be in the similar range of cable and wire in the early teens, and working capital is also expected to be of similar magnitude.
In which quarter does the FMEG business break even? The 10% by 2026 you all have been saying for a while, but when does it break even? Sometime early FY25?
My sense is every quarter we should be able to improve a bit. Though what you have noticed is right, that is slightly negative even now, but that is after considering the additional A&P spend which we have incurred in the current quarter. So the actual real profitability indeed has improved from first quarter to second quarter. We'll continue to make investment. We'll continue to pay attention to profitability. And my sense is every quarter we should be able to improve our profitability on FMEG.
Okay, all right. We'll leave it there, Mr. Jaisinghani, Mr. Tongia. Appreciate both of you coming on early on CNBC and sharing all those details with us. It's been a fabulous run, and we wish you all the best for the future as well. So that's Polycab, the first corporate on the program today. We're 7 minutes out from market opening. The pre-open session also will come up on your screen. Mitesh and Sudarshan are with us with their 9-10 calls. We're down 125. I think things have settled down, and we're going to start with about 100 plus point cut around the 19,550 levels. Mitesh, what do you have?
Prashant, I'll go with a sell on Bharat Forge, looking for targets of 1,070 and below, and a stop at 1125.
Sudarshan, your 9-10 call?
Manappuram is an intraday short with a stop above 145.
Okay, all right. Thanks a lot, gentlemen, for that. Let's see how this session goes. For starters, though, we're going to be starting below that, that level of around 19,550 odd. But plenty of stocks to focus on. First up, Nimesh joins us to tell us that standard brokerage report that he's picked for the day. Morning, Nimesh.
Morning, Nigel. So today's standard is on basically diagnostic companies. Goldman Sachs has turned bearish on the incumbents, and today they've downgraded both Dr. Lal Pathlabs as well as Metropolis to sell. Now, they believe that the market is underestimating the competitive dynamics given the rise in competition and slower integration of the newly acquired assets. Now, coming on Dr. Lal Pathlabs, they've downgraded to sell, target price 2,100. They see a structural decline in volumes to high single digit from double digits earlier, slower ramp up of Suburban as well as stretch valuations. The stock is trading at 54 times on an FY25 price to earning estimate. So that's on Dr. Lal Pathlabs. On Metropolises, they have a sell rating and they have a target price of 1285. Even for Metropolises, they believe that the competitive intensity is rising in the western region, therefore a threat to the volumes, as well as even for Metropolises, the valuations are stretched, and that is trading at close to 43 times on an FY25 estimated price to earnings. So a big downgrade on both Dr. Lal as well as Metropolises, and Goldman has turned bearish on both these two stocks.
Thank you very much for that. We'll watch for these stocks as the markets open up. But the MSCI quarterly index review is scheduled on the 14th of November. Vivek joins in to discuss the likely inclusions and exclusions. Vivek.
Well, that's right. So 14th November, it'll be midnight for us. So 15th is when we'll actually get to know which are the stocks that have been included or excluded from the MSCI. This is the quarterly index review scheduled in the month of November. The reason we are highlighting this today is that MSCI will actually set the set-off date or the cut-off date for making the list of stocks that actually make the inclusion, and that particular date will be set in this particular week itself. Apart from that, there are also a couple of companies, that have declared their results yesterday that are likely to make the MSCI cut this time around. First on our list is IndusInd Bank. Quant analysts were keenly anticipating the shareholding pattern along with the results, and in yesterday's shareholding pattern that the company has uploaded, the foreign headroom available is more than 15%, which indicates that the company is likely to make the cut and make the inclusion into the MSCI this time around. Analysts estimate, IIFL estimates that there could be inflows of almost $300 million into the stock this time around. Some of the other names, Macrotech, that is Lodha, could make the cut this time around. Tata Motors, DVR is also a likely candidate, estimated flows of almost $130 million. The other stock on the radar is Persistent Systems. The company declared its results yesterday, could make the cut, and flows of over $210 million is what is anticipated. Tata Communications, Polycab, another company that declared its results yesterday, could see flows of $165 million. Paytm, that is 197 Communication, and APL Apollo Tubes are also likely to make the cut. Apart from this, there is another stock, Suzlon, that has seen a significant rally this particular year. That stock too could make the cut into the MSCI this particular review.
Thank you very much for that. One IT stock we didn't chat about earlier is Oracle. They also reported their Q2 numbers, and it looks to be disappointing. The revenues have fallen by 1.2% quarter on quarter. It's just up 5% on a year-on-year basis. Margins have fallen. Margins for the company have consistently been above 40%. But this quarter, margins have fallen to about 38.5%. Profits too are down nearly 17% on a sequential basis. And considering the stock has gone up close to about 35% on a year-to-date basis, maybe there is a bit of a cool-off, in the prices. But some other stocks on our radar is Bandhan and IndusInd Bank. Bandhan, in fact, has seen two downgrades, one from Macquarie and the other one from CLSA. Ekta is here for more on that. Ekta.
Thanks for that. Well, yes, definitely. It has come in as a disappointment, especially because of the asset quality, which has worsened. Gross NPA ratio at 7.32% versus 6.76% Q-on-Q. Net NPA ratio has worsened as well. NII profit below estimates. Macquarie has downgraded the stock to neutral. Target price cut to 230 versus 280. According to them, the microfinance stress pool continues to increase. They've cut the EPS by 10 to 11% on an FY24, FY26 basis. CLSA has downgraded the stock to outperform from buy. Target price is cut to 270 from 290. Over the past 6 months, the gross NPL ratio in the MFI book has risen 450 basis points to 10.4%, unlike what other MFI players have reported. Apart from that, the quarter, according to them, was largely in line. That's Bandhan Bank.
Okay. Just kind of sort of kicking off the market opening, and we'll have the reverse rates coming up on your screens in just a bit from now. But there is going to be a fair bit to track. Mitesh, I think, is still with us. Mitesh, any last word before the market opens? I mean, you've been clear, steer away, at least from the index.
Yeah, Prashant, I think, what I'll watch out importantly today will be if the Bank Nifty bounces back from the 200 average. I think that bounce weakens, I'll go one short again.
Okay, all right, Videsh, thanks a lot for that. Well, a few seconds before we get market opening. For starters, we're going to start off with a cut of close to around 120 to around 125 points, in line with what the rest of Asia is doing. The first tick is lower. The market's open with a cut of close to around 120 points, but we bounced back a little bit from the day's low. Who's losing out? Wipro, one of the big losers. Well, that's down close to around 3.5–4% as we speak. The numbers didn't look good. The guidance is not impressive at all. Metal stocks are getting a bit of a knock. You have the dollar index that is stronger overnight. That normally doesn't spell very, very good times for metal. So you have Hindalco as well as Tata Steel. Both of them are a little bit lower. Bajaj Finance, yesterday it was one of the top losers on the Nifty. I think the street is a little bit skittish on their NIMs because earlier they were guiding for around 40 basis points cut. Now, in fact, they're talking about a 60 to 70 basis points cut. So that stock, in fact, has pulled back closer another percent on. What's doing well, though? Bajaj Auto. That's up more than 2.5%. Very, very good set of numbers. I think the EBITDA number for the quarter was closer around 2,000 crores. The street likes that. And IndusInd Bank as well is up closer around 2%. Add to the list, the outperformer from the IT pack is LTI Mindtree. Rima alerted us earlier as well. So that's opened up with a gain of around 2%. So we're still down closer around 110 points odd. The bulls will want to bounce from somewhere around these levels. Otherwise, maybe in fact we drift back to around the 90,500 and move even lower. Rima, I'll leave the broader markets to you, but just one stock that I wanted to highlight, which we are at CNBC-TV18 for trying to highlight this earlier as well about the low float companies. MMTC, in the first minute itself, it's down close to around 10%. So from yesterday's high, it's corrected more than 20%. And there are pending sell orders as well. In the first minute itself, there are close to around 8 lakh shares that have got traded.
Even STC is under pressure. ITI has lost ground. So pull up all these, PSUs with low float, and you can see the sell-off intensifying. A quick word on the earnings reaction from overnight. Shoppers Stop is down 4.5%. There was a margin decline. That's weighing on the stock. Oracle Finance margins below 40% after a very long time. We spoke about it. The stock is lower by 3.5%. Astral's numbers look good. Margin expansion, profits up 90%, but the stock has taken a beating, opening up with a cut of 2.5%. So perhaps the high valuations weighing. Dabur, there was that negative news that Mangalam spoke about, perhaps its hair relaxants causing some cancer. This is all alleged, there is lawsuits, and Dabur has seen a bit of a hit. Metropolis and Dr. Lal Path. This is on the back of the Goldman Sachs downgrade, and these stocks are lower by 1.5–2%. On the gaining side, you've got an ICICI Lombard reacting positively to its numbers. Persistent numbers look good, record high deal wins, and the stock is higher by 2%. Polycab, yesterday the stock fell after reporting good numbers, but today it's bounced back with a gain of close to about 1–1.5%. And Coforge is post numbers, they've held their guidance for the full year, and the stock is mildly higher. IFL Securities rallied hard yesterday post numbers, and that stock is opened up with another 2.5% gain.
Okay, well, the market's down 130, and we are basically at about 19,550 on the index. That's about 0.7% lower. So that's the start that we have on our hands. Take a look at the Nifty Bank as well, which has been the weaker of the two indices clearly. That's starting 0.6% lower at about 43,590 or so. So, the next support there comes in only at about the August lows, as we were saying. That's about 43,600. We are at 43,600, beg your pardon. Yeah, we are at 43,600. So straight off to that level. And will we see some support here? That's the question. Actually, on both the Nifty and the Bank Nifty, that is the question from here out. Maybe a few more names before we go any further. Market breadth is clearly negative. A little over 2 stocks down to 1 stock which is higher. Suzlon crossed 30 rupees yesterday. It's middling, not very much happening, but it's middling. Bandhan Bank is clearly down 2.6%. Wipro, we mentioned, 3% lower. There is Tata Steel, which is coming up with about a 2% cut. Hindalco is down to this metal stocks. Astral, by themselves, the numbers were okay, but compared to consensus, the numbers missed 1900, 1910 on Astral. There's Syngene, which is down about 2.5%. Yesterday, both Biocon and Syngene saw big moves. Ircon is down about 2%. And I think we're coming up with more names. Shriram Finance is another well-tracked name, which is down about 1.8% or so as we begin today's session. The clear winner now is Bajaj Auto. And you'll hear from the Bajaj management in the next 10 minutes. The stock's up 4%, 53.50 on the stock as we begin another session. Remember, nuclear software is up 10%. Almost 14.50. It's limit up, I think, locked up on very strong volumes, nuclear software. And I think Havells is the other one on the back of what Polycab has done. Havells is up to 2.5% this morning at about 13.75 or so. A fair bit coming up to start
Havells
the day
reports
with.
Numbers today.
Yes, Havells reports numbers. And, the rub-off perhaps will be there from what we've seen from Polycab. Max Healthcare is up 2%, Cyient is up 3%. So, there are more and more names joining the list. But it's a down start, 100 plus points, 19,545. Tahir Badshah is with us, CIO at Invesco Mutual Fund. Tahir, good to have you with us here. Thank you very much for your time. The last time you were on, Tahir, you were, we were talking mid caps and small caps. And, you were on the other side of the equation. You basically were saying that there are opportunities, still lots of opportunities, right? I mean, it's not all, as some have called it, not mid caps, but mad caps. I mean, you disagreed. Your thoughts with what we've seen so far, Tahir, especially for that part of the market, because, we are getting, that part is getting hit, but not as much as what large caps are doing.
Yeah, I think since we last spoke, I think we've probably seen that trend more or less continue. I mean, we've not really seen, despite some of the new challenges which has come up more from the perspective of the global markets as well as geopolitics. I think there's been a fair amount of resilience as far as that space is concerned. And I think I continue to maintain that what we are seeing even at our end from our research desks, we continue to see incremental opportunities come through our way. And, of course, there is a lot of diversity. I can't really call out that there is something which is concentrated in any particular sector, which is actually in a way good, because that is exactly what I've been trying to kind of convey, that there is a fair bit of broadening which is taking place in the market. New opportunities are arising. Many of the companies in different sectors are exhibiting a reasonably positive stance. And there are drivers which are emerging as well. Not all of them are probably consistent with the top-down thought process, but they're still, up and about. So I think I continue to maintain that, we probably may be getting too ahead of us by just thinking very narrowly about the fact that it's up 35% in the last 6 odd months or so, and therefore it's all done with. I disagree with that. I think there can be a possible correction. But in that process, I think one might probably lose out on the larger picture or the long-term picture in this segment, or in general in the domestic market as such.
Tahir, morning. Rima here. You want to share some interesting ideas, any thoughts on the IT earnings so far? And does it change in any way your portfolio constitution of tech names?
So I think there has been a clear, the result season up until now, most of the companies that have reported up until now, there are large caps and a couple of the mid caps also which are reporting now. And there seems to be a certain amount of pushback for sure. I mean, there is business which is coming through, but it is not starting to ramp up, or it is not starting to execute. And this is pretty much the trend across all the kind of companies. We've seen that, right? So I think it does push back the expected recovery in growth for FY25, maybe by a quarter or so. And to that extent, I think some of the rally which has happened in the recent times also puts them at a stage where valuations don't now necessarily, offer a lot of upside. We may probably see some bit of sideways movement, especially if a quarter or so of deferment continues. I think we are also reconciling ourselves with the fact that there are conditions in the US which can lead to some more, slowdown, even though gradual, coming through in calendar year 24. And we want to be alive to that fact as well. So I think, we've kind of pulled back a little bit as far as that sector is concerned.
Hi, Tahir. Good morning. Tahir, as we speak, the markets are under some pressure, but what's really kick-started for themselves is Bajaj Auto. The bike is zooming ahead as we speak. It's up close to around 5%. I remember the last few years, at times when there wasn't a lot of interest in the two-wheeler space, I think you were a little bit positive. How were you all positioned on the auto pack? And, within the auto pack, what do you like? Do you like the ancillaries, or do you like the two-wheelers, four-wheelers? What is it?
So at this stage, I don't think we are making a lot of differentiation between segments. We are just taking them as, opportunities within individual segments. There are companies which are gaining market share. There is product launch cycle rotating between different players at different points of time, whether be it in two-wheelers or whether be it in four-wheelers. And we're just trying to be on the right side of the growth momentum in across all these segments. So trying to put the best company out there forward in our allocations. We like a good set of companies, whether be it in four-wheelers or two-wheelers or even some of the ancillaries, but largely guided by where do you see the chances of market share gains and higher growth compared to compared to the overall market, and a possibility of earnings upgrades coming through.
What is the weightage of autos? Autos weightage, Tahir, as of now, as a percentage of your portfolio?
Well, auto ancillaries, I would reckon, would fall somewhere between 6 to 10% of the total portfolios in some of the diversified strategies. I would like to think that this is a sector which is still reasonably in good shape. There is growth which is coming by, of course, led by the festive season in the near term. But then, like as I said, there are certain bottom-up opportunities where you also feel confident about their ability to either retrieve, regain, or maintain market share. And that is something that we try to keep more in focus.
No, got that. Tahir, any other smaller segments, smaller areas, without talking stocks, where you think there's mispricing, where there is opportunity?
Yeah, I think what we've seen come through from our desks in the recent past has been, like as I said, quite diverse. We've seen opportunities in some pharmaceutical names. We've seen opportunities in certain commodity ancillaries of late. We have seen opportunities come through in a few of the retail categories, export-oriented companies. May not, like as I said, perhaps be consistent with the top-down view that we may probably see a slowdown and continuation of a slowdown as far as the global markets are concerned, particularly the US. But despite that, there are certain specific export-related opportunities which are coming through in certain consumer kind of products. So I think it's a pretty diverse, eclectic mix of different opportunities.
What can you go one level lower away in terms of is it commodity ancillaries, something in exports, consumer side?
Yeah, so that is the problem. The problem is that they don't really form cohesive sectors as such. So
correct.
It's difficult to call them out from that standpoint. But I think it's across a fair bit of subsegments of retail, subsegments of companies which are suppliers to commodity companies. There are certain companies which are in the pharmaceutical space. Of late, even some of the real estate opportunities have come into focus. I think we are seeing we are keenly observing the space where we can see premiumization. That's a very strong trend and theme which is emerging in almost every possible part of the market, be it in real estate, consumption, autos. So I think that is something which is there to stay. And at the same time, we are keeping an eye on a possible recovery at the lower end of the market. So that's how we are basically dividing our attention.
In real estate, Tahir, do you want to, because India's real estate market is many micro markets, right? Do you want to provide some more color where you do see, value right now and opportunity? Because I was just seeing your fact sheet. You don't own too much real estate in the funds that you manage so far.
No, so in terms of percentage, we don't really have very large exposures, but incrementally we are focused on some of the companies which provide or are likely to provide pan-India, opportunity and probably carry, a good brand pull in the market as well. And more importantly, they operate in the, premium to the luxury segment of the market. I think those are the spaces that we are trying to look at. And that is where some of the incremental opportunities are coming through. It's coming more through in the last some weeks, so probably they still don't reflect in our fact sheets, but you should see them in due course of time.
Okay, so incrementally adding to the real estate portfolio, pan-India players focusing on premium real estate, luxury. Thank you very much, Tahir, for joining in. We've got the management of Bajaj Auto waiting by. Bajaj Auto today is the top nifty gainer. They've reported an operationally very strong set of numbers. Their margins have gone up by 260 basis points on a year-on-year basis, coming in at 19.7%. Rakesh Sharma, ED of Bajaj Auto, is with us now on the show. Rakesh, that's the first question, right? Your margin performance, your quarterly EBITDA has surpassed 2,000 crore milestone for the first time ever. Where from here? 19.7% EBITDA. Do you see crossing that 20% mark? What are the raw material tailwinds in the second half of the year?
Morning. Yes, it's a hat trick of sorts because this is the third time we are saying in succession that this is our best quarter ever. And against the backdrop of a very difficult international environment, the margin performance has largely been carried through by an enrichment of the mix. When you compare it with the same period last year, the mix has really improved in favor of the premium motorcycles in the domestic business, a surging three-wheeler business, and because of some exchange rate improvements, realization improvements between Q2 of last year and this year. So that's what has sort of driven the margin improvement. Yes, we are dancing around the 20% mark, and it is true that the commodities are soft right now. Our pricing is, early action in pricing has given us the benefits, and it's just a matter of now the mix falling in place, and we could probably be on the right side of 20 also. But it's very difficult to be precise at this point of time.
What's the contribution of premium motorcycles currently?
So in the domestic business, while the industry is about 50% above the 125cc mark, which is what broadly we are defining as premium motorcycles where people like to upgrade, we are at 65%. So 65% of Bajaj domestic motorcycles are 125cc and above.
All right. Hi, Mr. Sharma. First of all, congratulations on a good showing. A few quarters ago, things were looking far more, a little bit skitty, actually. And now, in fact, stock is doing well. Commentary is fairly okay as well. But the way ahead, could you tell us what's the market share? I think you'll have gained some market share. So could you tell us what is it currently and how do you see your market share going ahead? And also if you could specify, at times you talk about 125cc plus or only motorcycles. So give us a sense on that front.
So the market share at an overall level in the domestic motorcycles business has gained a couple of percentage points between Q2 of last year and this one in retail terms. We like to look at understanding the markets and look at market shares on the basis of retail rather than billing, because billing, even though it drives the P&L, it is really depends on channels, stocking strategies, etc. So a couple of percentage points we have gained, but more importantly, our area of focus, the segment which is enjoying the tailwinds in the industry, which is the 125cc plus segment, there we are now at about 30% market share. And within that also, the 150cc plus segment, which is the traditional home ground of Bajaj Auto, we have now crossed 40%. So we are, quite decisively the market leader over there.
Mr. Sharma, hi, good morning. I remember a couple of weeks back, I think it was JP Morgan put out a note, their analyst saying, was a note about Bajaj saying, don't ignore the EV push. So I want to talk about the EV space and what would you do? So I think on the two-wheeler side, you're doing, e-Chetak is doing about 8,000 units per month. Could you tell us what would you do going forward, say in the third quarter and beyond? And on the three-wheeler side, on the electric front, I think you've already soft launched in many cities. What are plans there? What do you see in terms of visibility? And also a little bit of margins there on the electric three-wheeler front, sir. Will they be similar to the ICE engines?
Yeah, so there's quite a few questions out there, but let me just take it one by one. On the e-two-wheelers, which is Chetak, as you know that a few quarters ago, we were really preoccupied with getting our supply chain and R&D right, and we had a hiatus in the marketplace. But once that has been put right, from quarter one, around February, March onwards, we have a much better view of the availabilities, costs, and margins. And therefore, we have stepped on it. And you would have seen that our market share has increased from 4% exit of FY23 to 11% in September. And that's on the basis of availability. That's on the basis of pricing, better pricing. It is because we have been able to restructure our product costs. Going forward, the same work is going to help us to continue to expand the network. We are right now in 120 cities. By the end of the year, we should be in 180 cities with an exclusive Chetak experience store format. It will help us to expand the range. You will see in this quarter that we will launch more products, and in 6 months following that, you will see another bout of range expansion. And the third thing which it does is allows us to therefore increase our volumes. We are looking forward to breaching the 10,000 mark in Q3 and building on that as we go forward. So that's the story on electric Chetak. But the thing which we are watching very carefully is how penetration is improving in electric two-wheelers. For some months now, it has been stagnant at 5% of the motorcycle space. And this is particularly after the FAME subsidies were cut. There is going to be some sparkle in October, but the dust will settle down in November, December, allowing us to judge whether there is really, the industry is going to break free from the 65,000 units, which it has been stuck per month, which has been stuck for the last 3-4 months. But be that as it may, we are very, very clear that we are going to be pushing forth in this. On the three-wheelers, before I just get on to the electric three-wheelers, it's pertinent to mention that, the star, when you asked me about market shares in the previous question, the star performer really is the three-wheeler this quarter, with our highest ever sales in a quarter and in a month. We crossed 50,000 units in September, and our market share has surged to 80%. So therefore, that sets a very good benchmark for us when we introduce the electric three-wheeler. Again, because of the supply chain and R&D work, the three-wheeler margins are agnostic to the powertrain. I mean, we are making very similar margins in ICE side as well as the electric side. The electric three-wheelers were launched by the end of Q1, and we have done a Q2. Almost 2,000 units of electric three-wheelers have been put into the marketplace, very carefully selected cities in the north, and we have surged to a 70% market share in the city which we have launched in, which has given, and we've got tremendous user feedback, some minor improvements which have to be done, and we are rolling it out. We are already in 10 cities. In another 6 months, we should be in 40 cities. What this does for us is that this is absolutely incremental business, because as you know, the north and parts of the east, they have severe restrictions for ICE autos. And that space has been occupied by, these contraptions, these e-rigs, which have been hurriedly put together and imported from China. And first lead acid based and then lithium ion. So this, now with the e-auto, our experience in our pilot markets tells us that all those people who have sort of had 2 years of experience with e-rig are very, very good targets for upgrading to e-autos. So this brings absolutely new business to us, which is even EBITDA-wise at the same level as ICE autos.
Okay, all right, Mr. Sharma. So it seems you're outperforming the market in various verticals. So good for your business. And in today's trading session, the stock price as well is outperforming what the market is doing. We look forward to having a chat with you at the end of this month when you'll come up with your monthly numbers as well. For the time being, we slip into a short break. On the other side, we'll be joined by the management of Astral, which is under some pressure, though those numbers looked quite good. Don't go anywhere. Welcome back. Well, the markets are almost testing that 19,500 odd mark. So we're at a very, very crucial juncture. I think the low of the day is 19,515. But another stock that's actually lower in trade is Astral. It's the next corporate on our radar. The quarter performance, in fact, came in line with what the street was working with. The volume growth in the piping segment was up closer on 28%. Mr. Savlani, the executive director and CFO of the company, joins us on the show. Hi, Mr. Savlani. Good morning, and thanks so much for joining in. In the last couple of times we have been chatting, you have been talking about your volume guidance of closer around 15%. But I recall you telling me at the end of quarter one, we could possibly revise it at the end of quarter two. At the half-year mark, do you want to revise that volume guidance number for the year? Because you have done very well in the first half.
Yeah, you are right. We have done excellent, better than what we have originally planned. So definitely volumes will be better only in the coming time. So even if we next half we do 12-13%, then also we will cross the 20% annualized number. So definitely we are increasing our guidance 20% plus in volume terms. And looking to the market situation, I think everything is in our favor. Construction activities are picking up. Even you see the polymers are at the bottom level. And because of that, the gap between the unorganized and organized prices have come down. I think everything is in our favor. Plus our East plant is operational. Now our Guwahati plant has also started functioning from this week. So everything is looking very, very lucrative to us. And because of that, we are confident that we can easily cross the 20% plus mark.
Okay, volumes will grow 20% plus in FY24, right, sir?
Yes.
And what about revenues? I think revenues, the number was 15% the last time we spoke for the full year, which we put out. Yeah.
Revenue depend on the polymer movement, but I think polymer is also looking now almost bottom out. From here on, we are not expecting that the prices will go further down from here. So if the polymer start going up, and normally we have seen in the past also, now the seasonal months are starting, and in seasonal month, normally the polymer price goes up. If the polymer price goes up from here, then definitely revenue will also be very, very excellent, I can say. And now the base effect of polymer is also done away, because the last year the polymer prices were very high in the first half. So now it has come down and we are moving into the second half. So that base effect will also go away. So from here on, the value will also be excellent.
So just getting back on that guidance, you've done 28% volumes in H1. If you have to do a 20% plus for the full year, in H2, the company needs to do 12 to 13%. So are you expecting H2 to be weaker than H1? Will H2 not be similar?
I am telling, even if we do 12, 13, then also we will cross the 20. So our guidance is more than 20.
Okay. But you could end up with closer to 25% plus, right? Is there any reason to believe?
Yeah, we will try our best to even reach that mark also.
Okay. Sir, I would say you say 20%. You do 25.
I said minimum 20%. We will cross 20%. I have not said 20%. I said we'll cross 20%.
You want to give us the maximum number?
Because the reason I'm saying that is because you see, lots of companies we speak to, they guide lower and then beat. But you're calling it as you see it. So I appreciate that absolutely. But, the downside of that is that market keeps revising their estimates, expectations higher and higher. So then, that's the thing. But you're saying that you will do at least 20%, right? Volumes, FY24.
Exactly. You see the history of Astral, we are a conservative company. We always guide low and try to deliver more. And that is what our history of last 15 years.
Okay.
So what about bathware segment? When do you break even? Will it happen in the second half of this year?
I think originally plan was that in the Q4 we should be break even. So we are trying on that direction. But right now we are spending little more amount on little spending on the branding side also. So it may extend 1 or 2 quarters for the break even.
Okay, so maybe then bathware segment will break even in the first half of the next fiscal year.
Exactly. Definitely it will break even.
And you were doing revenues of around 5 crores per month. That number will go up, right? So how do you see that scaling up?
This quarter it was 6 crores per month.
6 crores. And how do you see that number scaling up from here for quarter 3 and quarter 4?
So I think continuously every quarter on quarter you will see in the next 6-7 quarter it will continuously go up because base is still negligible.
And at what level do you break even, in terms of monthly sales? You're doing 5, now you're doing 6. At what revenue level do you break even for bathware?
I think once we will be around 9 to 10 crore, we will be breaking.
Got it. All right, lovely. Also, let's focus on the other segment. That's the paints and the adhesives business. Now, that is the smaller part of your business, but that's doing well as well. And your margin has clocked closer around 10%. Could you tell us, how do you see revenue shaping up? Now you're closer around 400 crores on a quarterly basis. So how do you see that number move up? And margins, are they sustainable at 10%? Can they do better?
I think margins on EBITDA level, it is much higher. It is not 10%, it is 15.4%. So
we have got it, sir. EBIT margins is what I was talking about. EBITDA, as you're saying, will be better. Yes.
Yes.
Go ahead.
So I think it is a sustainable. On the contrary, we are expecting that it will further improve from here on, because most of the chemical prices have bottomed out. And from here on, we are expecting that the prices will start moving upward direction. And secondly, whatever the higher cost inventory was there in the system, that is also exhausted. So from here on, we are expecting little improvement into the margin, and growth run rate will also improve. Normally, second half betterment is always there. And we are expecting a good number from the UK also, because UK was little lower than our expectation in the first half. But second half, we have planned out in such a way that that geography will also give us a good number in the second half.
What's the progress, sir, on the capex? You have 3 ongoing projects. The Assam one, where piping will start by Q3, the Telangana facility with a capex of 100 crore, the Dahej adhesive facility. Could you give us an update? Is there any change in the timelines?
So like Dahej, we already started. So that is up and running. Secondly, Guwahati, our tank operation has already started. 5 we are expecting shortly to commence. So these 2 projects are already on. And our Telangana project is going on with full swing. So we are expecting that the second quarter of next year, Telangana will be also operational. And then after, we are expecting that our Kanpur project will also come maybe by end of the next year.
Could you give us some details about this Kanpur project?
So I think we spent 30 crore rupees of land, and right now the construction activity we are going to start shortly, and we are putting up 60,000 metric ton plant over there.
Got it. So just one last question. I think you said that new businesses will eventually, you see it scaling up to about 1,500 crores over the next few years. With the, as you said, I mean, the break-even for one business perhaps has been brought forward. You expect break-even sooner. Any updated numbers there, or, I mean, that was a slightly longer-term guidance, that 1,500 crore number.
Yes,
but, yeah.
We have given the guidance for next 5 years. So keep little patient. We will definitely, we are confident that we will be able to deliver that number. And the kind of performance which we are seeing for all our new products, whether it is a water tank, whether it is a valve, whether it is a drain pro pipe, whether it is a silencio pipe, I think everything is working on track. And that is why you can see very healthy margin in spite of so much of volatility there in the polymer price. I think we are working on the highest margin in the industry. So I think we are very well on track, and we are confident that we will be achieving the 1,500 crore mark what we have guided.
All right. Thank you very much. We leave it there, sir, and good luck. It's always a pleasure having you with us here and speaking with you on CNBC-TV18. Thank you. Well, that is the management of Astral with their numbers. It's a down market, so I guess Astral is taking a bit of hit as well. But no part of that conversation was there any indication of softness here, there, anything. I mean, as robust and as positive as ever, commentary coming in from the management. ICICI Lombard is now on our radar. It was a good quarter for the company. Net premium witnessed a healthy growth, while combined ratio has also improved. We have Mr. Gopal Balachandran, CFO and CRO at ICICI Lombard, now joining us to take some questions. Mr. Balachandran, good morning. Good to have you with us here. Thanks very much. I have to begin by asking you what the recent tragic floods that happened in Sikkim and some of the other sort of incidents which have happened recently. What has been? Have you been able to put an estimate to your exposure to these, and would you like to share that with us?
Yeah, so good morning, Prashant, and good morning to all your viewers. So I think when you look at it in the context of some of these flood or cat events, in the past, as I have mentioned even earlier, we used to talk about maybe at best one or two cat events in a year. Today, possibly what we are encountering is maybe one or two events every quarter. So thanks to maybe some of the climate change related events. Having said that, I think in Q1, we had the cyclone Biparjoy, which had a significant impact. On the net claims for us, we had an impact of almost about 35 crores. In Q2, I think we had seen a lot of events, particularly, let's say, some of the floods that happened in the northern part of the country. Now, there again, obviously, we did get impacted. We had roughly close to about 800 claims getting intimated. And insofar as the net impact of those losses on our P&L, that number was roughly about 48 crores. So every quarter, I think we do get to see some of these cat events play out. Insofar as the way we manage the overall exposure is we also put in place adequate reinsurance support so that in the event we find losses exceeding a particular threshold, they are kind of reinsured and we get recoveries from the reinsurance partners. But on balance, I think when you look at it, what we have also seen, consequent to some of these increased catastrophic losses, there has also been an increase in reinsurance rates. And therefore, to that extent, logically, this should also translate into better pricing insofar as the overall market is concerned.
So 35 crore net impact in Q1 because of events, 48 crores you said in Q2. In Q3, what should that number approximately be? Would it be in the same range or would it be much higher?
Very difficult, Prashant. I think we will obviously have to wait for, let's say, these events to play out. I think we only expect that the scale and the magnitude of these events possibly kind of are limited. But we will have to wait and see. Maybe we'll be able to give a better guidance when we announce numbers in Q3.
Sir, I believe you had given a guidance of high teens growth for the gross direct premium income. Does that stay for the full year?
So, Rima, again, when you look at it, you are absolutely right. I think let's look at it from, let's say, our half year or let's say even on a quarter-on-quarter basis. On a half-year basis, the industry grew at roughly about 15%. We grew at about 18%. For Q2, if you look at it, I think the industry grew slightly lower at about 12.5-13%. Vis-a-vis that, I think we grew at about 17%. Now, when you look at the longer-term growth trajectory for the GI sector, for the last 23 years, the industry has grown at about 15-16%. So there is no reason why this market, as I said, even for the half year, has grown at almost about similar numbers as 15% or thereabout. So even for a full year basis, the expectation is with activities happening across lines of businesses, markets should continue to grow in high teens. And whenever the markets generally have grown responsibly, ICICI Lombard has generally delivered 100 to 200 basis points growth over and above the market growth rates. So hence, that's the kind of trajectory that we would kind of largely work with and see the developments of the market as on an ongoing basis.
All right. Hi, sir. Morning. Could you give us a couple of numbers? So what is your combined ratio likely to move to? It's cooled off 120 basis points odd. Where do you end this year with? And also your claim ratio, that as well has come off close to 200 basis points.
Yeah, so Nigel, again, I think when you look at it from what we spoke even last time, I think we have spoken to the market towards bringing down our combined, which used to be in that range of around 104% plus earlier. The objective is to kind of bring it down to 102% by the end of FY25. And we are pretty much on course to in that direction to get our combined down to those levels. In terms of the split between the loss ratios and the expense ratios will be purely a function of what kind of mix of businesses that we write. So very difficult to specifically call out in terms of what exactly could be the loss ratio and what could be the expense ratios. But broadly, if you look at it, from a loss ratio perspective, we have kind of stayed in the range of around between 70 to 75% in that kind of range. And when you look at the expense of management number, let's say for this half year, we are operating at an expense of management closer to about 26.9%. But well on course towards the objective of combined going down to 102 by the end of next financial year.
So you operate across various segments: motor, health, crop. Crop, your presence is quite less. But amongst all these segments, where is it that you are seeing maximum growth? Where is it that competitive intensity has picked up? Can you just give us some industry trends that you've observed over the last 3 months, and what can you guide for the second half?
So, Iman, it's a great question. So, if you look at segments that you rightly mentioned, whether it's motor, health, or commercial lines, all of them are preferred segments for us. And directionally, I think when we look at the opportunity that each of these segments presents in the market context is very, very positive. And within that, ICICI Lombard, obviously, as I said, wants to kind of leverage on this incremental growth potential. If you look at each of these segments, so let's take health as a category, for example. For the half, historically, also in general, I think we have been kind of growing quite well on this segment. But if you look at just for the half year, the industry grew at roughly about 24-25% on the health as an overall category. ICICI Lombard grew at almost close to about 31%. Now, this growth in health was aided by growth both in retail health as well as, let's say, corporate or employer-employee segment. So in that sense, I think we have been able to have an outperformance insofar as the corporate health segment is concerned. But on an increasing basis, we are also witnessing slightly elevated levels of competition in this particular segment, and therefore we will see how things play out for the rest of the year. Insofar as the commercial lines is concerned, which is the typical product offerings that you make to a corporate, whether it is with respect to fire, engineering, marine cargo, liability, etc., etc. There again, I think we have had an industry-beating number. Industry has grown at maybe a high single-digit number. Our growth has been upwards of 16-17%. And this is something not just this year. Consistently over the last several years, we have been able to have outperformance on commercial lines as a category, and we believe even the trajectory going forward looks very, very promising given the scale of infrastructure investments and activities that is happening on the ground. Should kind of help us to sustain similar level of outperformance on the commercial lines. The third category on motor, again, if you look at that's one segment, we have been a bit guarded given the relative higher competitive intensity that we have seen in this segment operating particularly over the last 18 to 24 months. But of late, I think we have seen a bit of easing happening in the market. It still remains competitive, and hence we have been taking a guarded stance. But on a sequential basis, when you look at our growth trajectory, again, it is looking very, very promising. For example, we grew in Q1 on motor by roughly about 5-6%. Q2, our growth is about 11%. And the gap between us and the industry growth rate has significantly got narrowed. And with now, let's say, the changes in the expense of management guideline playing out, and roughly 50% of the market operating at a threshold higher than the stipulated levels, if once that course corrects, we should also be able to get better growth rates. And towards the end of the year, we should see even growth in motor for us in line with the industry numbers. For ICICI Lombard, the expense of management has been well within the threshold.
Okay, all right. On that optimistic note, then we let you go at that. Thanks so much, sir, for joining in and giving us all those details, and wishing you all the best for the second half of this fiscal. By the way, we'll be having that chat. You know, the Nifty went down to around 19,512, and it's seen a good bounce. It seems, you know, in cricketing terms, the team was in trouble. The two heavyweights came in there. They lifted up the bats and they've gone out to bat. Who is it? HDFC Bank and ICICI Bank. Both of them have cut their losses. And that's why the Nifty Bank, that was actually down close to around, 350 points odd, that's cut its losses. Both these two stocks have come off the day's low. And HDFC Bank in particular, that went to around 1,503 and it's bounced off that mark. You know, that's going to be the big mover. The bulls need to fight back. We need to see the Nifty Bank doing an outperformance. And after a while, if you pull up the Nifty and the Nifty Bank, you'll see the Nifty Bank is outperforming the Nifty today because the Nifty Bank is down close to around 0.2%, while the Nifty is down 0.4% or thereabouts. That's the bounce that we're seeing, and the Nifty making a bit of a dash.
You know,
Mitesh,
the bank Nifty has seen a 200-point bounce from the day's low, and the Nifty has seen that 80-odd point bounce. Basically the lows have been on the bank Nifty. We said, well, the 43,600 comes into view. I mean, the 43,600 also broke. The low is 43,558. But then now we are comfortably back above that level. On the Nifty, the level was 19,500. And I think on that one at least, the low has been 19,512. So didn't quite go there. Now, hopefully these levels hold for the rest of the day and we don't see one more leg lower. Mitesh is with us with a quick check on things. Mitesh, what do you do here? You got a decent bounce. Would you try to dip your feet in or stay away still?
I would want to go short, Prashant. So my idea is that while we've had a good bounce back, the structure is very weak. And, for the Nifty, I suspect that we should possibly break 19,500. We got a low of around 19,512. So we bounce back from support levels. But as we get closer to the 19,650, 19,630 zones, I would suspect that selling should re-emerge. And with the weak structure, there's a good chance of us heading lower. So around 19,630, 650, I would want to buy into put options of 19,600 strike. and take a stop above 19,730. So unless until the Nifty spot gets past 19,730, I would maintain a put position on my index basis and would look at a retest of 19,500 and possibly a break below that. So next couple of days, I still suspect that it could be trading more on the negative side, despite the fact that we've had a very good recovery in the first 1 hour.
Thank you for that. Here's what we'll do. We'll slip into a very short break. On the other side is our special segment, Quarter Se Quarter Tak. We put the spotlight on the expectations from the chemicals sector. Stay tuned. Okay, welcome back. Let's talk about Quarter Se Quarter Tak. And this time we are putting the spotlight on the chemical sector. Sonal joins in for the key expectations. Sonal.
Thank you for that. Well, Q2 is expected to be weak again for chemicals and agrochemical space. Let's start with chemical companies. They continue to grapple with destocking. There is price erosion as well due to dumping coming in from China. And there's still weak demand in the end-use industries. And companies that cater to agrochemicals and refrigerant gas will continue to witness pressure. And that also means agrochemicals will also continue to see subdued performance, and domestic industry is expected to see mid-single to low double-digit growth on a YOY basis, which is lower than in the historical levels. Now let's look at some of the companies and how they are expected to perform. Let's start with SRF. It's expected to be weak, where EBITDA is expected to decline 15.5% sequentially on a YY basis and 5% sequentially. Weakness will be driven by chemicals business. Packaging business is expected to remain flat, and films business will see modest improvement. Now, Gujarat Fluorochemicals is also expected to be weak, with revenues declining 30% and EBITDA declining 60% on a YOY basis. Now, interestingly, strong performance is expected to continue for PI Industries and Navin Fluorine. PI Industries revenue growth of 27%, EBITDA growth of 28% and PAT growth of 27% is expected, which will be driven by the CSM or the export business. For Navin Fluorine, growth in HPP segment will lead to a 5% sequential growth in revenues, 4% in EBITDA and 5% in profit after tax. Now to the key things to watch out for in different companies. For Aarti Industries, the exports demand, the recovery in discretionary volumes and the segments as well, and volume growth as well. For UPL, it would be demand environment across markets. For Deepak Nitrite, phenol acetone spreads, they've been coming down, the execution of new projects. For Navin Fluorine, the most important would be induction of new MD or CEO and new projects approvals as well, which are expected. These are some companies because the chemicals and agrochemicals universe is very large. Leaving you with the valuation table as well. Valuations have come off from the highs but still rich in some cases. Aarti at 22 times, Atul at 32 times, we have Deepak Nitrite at 20 times, SRF 26.5 times, Dhanuka and UPL between 11 to 14 times, Vinity Organics at 38 times, and the others are on the screen for you.
Thank you very much for that. Swarnendu Bhushan, the co-head of research at Prabhudas Leeladhar, joins in now. Swarnendu, Q1 was weak. The expectation, as Sonal pointed out, is that this weakness will continue. There's destocking, price erosion, China dumping, etc. But does this, how long do you expect this weakness to, continue for the chemical stocks? And at what point do the stocks bottom out even before demand does?
So very nicely put up by Sonal as to what are the concerns on the sector right now. And we don't anticipate that the weakness that we are witnessing in agrochemical demand per se, or maybe textile per se, where a lot of dyes, pigments and other chemicals go as intermediates over there. We don't see any normalization of demand, say 6 months down the road as well. So from that perspective, it's quite a while before the demand starts normalizing and the margins start improving for most of the chemical companies.
Okay, any standouts at all to your mind in this particular earnings season?
So what has happened is that crude, we have seen that almost 10% improvement quarter on quarter from $78 to $87 per barrel. And most of the feedstock which go into these specialty chemical companies like benzene, toluene, phenol, they have also commensurately jumped almost 10 to 12% quarter on quarter. And that amidst a weak demand scenario will be catastrophic for the margins, EBITDA margins of the companies in Q2 per se. On the other side, you would see that fluorspar prices, for example, quarter on quarter, we have seen marginal decline in that. Acrylonitrile also, we have seen that marginal decline in prices have been there quarter on quarter. So that could benefit Vinity Organics, for example, the main product being ATBS, which goes into drilling and water treatment. And we have seen that crude oil prices strengthening means that you will see rig counts will keep on increasing, and along with that you will see that ATBS realization and your demand will also improve. So we expect that Vinati could do better. Some improvement as has already been pointed out in Navin Fluorine. Since in first quarter they had shut down in the HFO segment. So from that perspective, these two companies are the ones that you could watch out.
What's the target price on Navin Fluorine and Vinity? And do you have any sell calls?
So on Navin Fluorine, you could see 12-15% upside from here, and similar upsides in Vinity Organics too. We recently came out with a reduced note on Deepak Nitrite. So stock is holding well around 2100 odd, and we expect that stock to correct down to 1800 odds within a year, as we see that a lot of phenol capacities are being put up in China. So within last few months itself, they have installed roughly 1 million ton of phenol capacities, whereas China used to be a net importer of, say, close to 400,000 metric ton a year. So we are expecting that as China moves towards self-sufficiency in phenol and later on becomes a net exporter of phenol, you would see structural headwinds in phenol margins, which will be affecting Deepak Nitrite adversely.
Okay, so Naveen and Vinati on the better side of things, and Deepak Nitrite perhaps gets hurt more in the coming quarters. Thank you very much for joining us. Great speaking with you and getting that perspective. We'll take a quick commercial break here with news of just the markets and what they're doing. I mean, so the recovery for now is holding. We're down 90 points and about 80 points off the 70 points off the day's low. We'll take a quick commercial break here. On the other side, it's our special segment. It's the economy. Ladha will get chatting with Jahangir Aziz of JP Morgan to discuss the surge in US bond yields and its impact here in Asia and India. Stay tuned.